to today's Daily Dose of Market Insights. Very good morning to all. I'm Kelvin here. Today will be the Wednesday, the 8th of October 2025. So as usual, before we kickstart today's Daily Dose, let's have a quick look at the disclaimer first. All right, let's make sure that the screen is on. Okay, I think it should be fine. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is for general information purposes and is not investment advice. Past information is not representative of future results. Okay. Okay, so let's get kick-started in today's Daily Dose of Market Insights. So before I jump straight into those short-term intraday technical outlook, let's have a quick recap what has taken shape yesterday in terms of news flow, economic data release, and as well as their respective impact on the broad-based cross-asset classes on the intraday movement. So yesterday, we do have this negative news flow coming up from one of the AI optimism productivity, high productivity team play in the US stock market, which is pertaining to Oracle and NVIDIA over here. So what is this news flow? So this particular news flow, there was a report saying that Oracle profit margin in its cloud computing business is lower than many on the Wall Street that has been estimating. So we know that Oracle in the last 3 to 4 weeks or so has a very strong rally, a tremendous rally, about 20% to 30% plus after it inked up at that billion-dollar deal with OpenAI and as well as NVIDIA to indirectly, I would say, to actually kind of rent NVIDIA core chips to power Oracle business operation over here. So while Oracle generated roughly 900 million in revenue from the rental of services powered by NVIDIA core chips during the 3 months ended in August, the company only managed about 125 million in gross profit. The information reported. The information is the portal that reported this potential so-called Oracle profit margin is actually lesser than what Wall Street analysts has been estimating, citing internal corporate documents. So Oracle shares fell as much as 7.1% on Tuesday over here before pairing the decline, and NVIDIA dipped 0.6%. All right, so because of this negative news flow over here at the start of the US session, we see it tumbling downwards in the broad-based market. But what's interesting over here is that despite that initial fall in the first half of the US session, market participants or the deep buyers starts to come in at around 12 a.m. to 2 p.m. Singapore time, stabilizing the negative we call it initial negative sentiment in the US stock market. So the S&P ended a negative 0.38%, the Nasdaq 100 ended negative 0.55%, the Dow Jones Industrial Average almost unscattered, down only negative 0.2%, and surprisingly, the Russell 2000 managed to have a gate. Okay, sorry, I think this one is, ignore this, this is the current intraday movement. So the Russell 2000 yesterday managed to, it was the underperformer yesterday, down negative 1.2%. All right, pardon me. So this is the intraday CFD index. So yesterday movement of the Russell 2000 was the underperformer, down negative 1.12%. But I mentioned for the other major stock indices, the S&P, the Nasdaq, and the Dow Jones, deep buyers came in between 1 a.m. to 2 p.m. Singapore time to stabilize the initial sell-off that has taken shape at the first half of the US session yesterday due to Oracle negative news flow. And what we could see is right now, the E-mini S&P futures continues to rise positive, up 0.14% during the Asia session, what you could see over here, and followed by the Nasdaq 100 E-mini futures also up 0.18% as well, almost the same magnitude. So it seems to us that there is some form of interim support that is being formed on the major US stock indices after yesterday's initial sell-off. So later I'll touch on the intraday technical outlook chart on our 3 major US CFD, US stock indices CFD index that we cover on a frequently basis, which is namely the SPX 500, the Nasdaq 100, and the US Wall Street 30 that is representing the Dow Jones Industrial Average over here. Then another big movement I will share with you guys on the FX market is you continue to see pronounced US dollar strength that has kickstarted, that continues to be enforced since the start of this week, primarily driven by the very weak Japanese yen, where market participants right now is anticipating that the new Japanese incoming Prime Minister Takashi, she will start to evoke the Abe era kind of Abenomics 2.0, where potentially she will push up for a weaker Japanese yen to actually stimulate the Japanese economy. But however, in my own opinion, that doesn't really gel well with the fundamentals of what the Japanese economy is doing right now. But given the fact that it's actually more potential for Bank of Japan to continue to normalize its gradual interest rate hike to force the Japanese consumer and businesses to start spending rather than keeping low rates for a long period of time, and that potential could lead back to stagflation again, given that the economic situation in Japan has really started to turn around in the last 2 years. So, but however, markets tends to be very short-term in nature. Once certain levels has been taken out on the dollar yen, we got to respect that ongoing sentiment that tends to deviate away from other intermarket fundamental factors. Later I'll share with you what about that, what's that is all about. All right, so now the intraday movement we could see is that this the FX market very clearly the dollar is the strongest against the Japanese yen right now, up by 3.75%. That's the 5-day rolling performance of the US dollar against other major currency. So very clearly a lot of stop loss level is being triggered on the dollar yen, those who has the on the short side position, given that yesterday it clearly cleared above the 150.70 resistance level. So I'll talk more about that when I cover the technical chart of the dollar yen. So another movement that has taken shape this morning that exacerbated the strength of the US dollar is RBNZ, which is the New Zealand Central Bank. Not really a major central bank, but its action could have a negative or positive feedback loop into the FX market. Yet RBNZ surprised the market with a larger cut of 50 basis point. So earlier today, market is only expecting 25 basis point cut on the New Zealand Central Bank, but the New Zealand Central Bank opt for a larger cut, citing that weak demand that has seeped into the New Zealand economy over here. Right. So New Zealand Central Bank cut interest rate by 50 basis point, and it said that it's open to further reduction to stimulate the weak demand that is prevalent in the economy, in the New Zealand economy over here. So this will be the 8th cut so far by RBNZ since late 2024, so to bring down their short-term official cash rate to 2.5%. And the New Zealand dollar dropped to 1% against the US dollar today and fall to close to about the lowest level since April this year. So if you look at the chart of the Kiwi versus the dollar, very clearly it plummeted below after failure to break above the 20-day and the 200-day moving average at the start of this week, and potentially now is at the lowest level since April this year, with the next two key support coming in at this is the daily chart of the Kiwi dollar, the New Zealand dollar versus the US dollar at 0.5650, followed by the major support level, which is the major swing low of 3rd of February 2025 and 10th of April 2025 at 0.5520 level. So overall, this two movement in the FX market, one from the yen, one from the Kiwi, created a extension of this positive feedback loop into the US dollar. So if you look at the US dollar index right now as we are speaking, that is considered as a broad gauge of whether the dollar is strengthening or the dollar is weakening. The dollar now is actually the dollar index now is actually probing this resistance level at 98.90 over here. So what if today's it managed to have a clear break above 98.90, it could potentially retest 100.10 level. So this level was actually the so-called the sell-off or the tipping point that previously held previous dollar strength movement from the low of July to end of July. So that's during the summer rally of the US dollar, and the rally stopped because of the very weak US non-farm payroll data report that was out earlier on the 1st of August that actually kept dollar upside over here. So right now, the movement of this US dollar is not driven by the US economy as per se, or factors pertaining to the US economy, but rather factors related to the Japanese economy or the Japanese political situation right now, and as well as the much more weaker state of a New Zealand economy, where RBNZ cut interest rate by more than expected, which is today by 50 basis points, that caused the dollar strength to extend in today's Asia session. So what I could see is that the dollar index now starts to go into a very sideways choppy movement again after failure to break above the major long-term circular support at 97.3 earlier on the 15th of September, where it had a weekly close above it and at 97.3. So very likely that means it will starts to be in the sideways range configuration. And bear in mind, the US Federal Reserve is still on the path of cutting rates, not hiking rates and not holding rates. Why? Because the CME Fed Watch 2, which is the taking into account of the trading behavior of the Fed Funds futures traders in the Fed Funds futures market, still continues to assign high chance of 94.6% that the Fed will do another second cut for this year on the upcoming 29th October meeting to bring the Fed funds rate down to 4% to 4.25%. And going down the calendar, we still see a high chance of 82.75% that the Fed potentially could engineer a third cut for this year to bring down the Fed funds rate to 3.5% to 3.75% on the last meeting for this year, which is the 10th of December 2025 FOMC meeting. And the market is also still expecting 2 more interest rate cuts in 2026 so far. All right, over here, based on the probability that is being seen on this Fed Funds CME Fed Watch 2 aggregated tab. All right, so all in all, the rally in the US dollar that is being seen at the start of this week is more driven by non-US economy factors, given the fact that the Fed is still on the path of cutting rates, not hiking or holding rates, as deemed by the latest price action trading behavior of the Fed Funds futures trader, modeled by the CME Fed Watch 2. So, but nevertheless, even though it goes against the fundamental, but in a short-term basis, we got to respect this short-term price action behavior that has started to kickstart in the US dollar, which is strengthening on the shorter term, and we got to adjust accordingly based on levels that has been taken out. Later I'll explain to you when I look into the individual FX charts. At individual intraday FX, the major dollar FX pair charts. All right, and despite that the dollar is strengthening over here, because market participants in the Fed Funds futures market are still looking for a dovish Fed going forward down the road, and as well as this ongoing US government shutdown that could potentially see a bit of geopolitical risk premium on the US Treasury. So that could continue to see much more debasement away from the US dollar. So that causes gold to rally as well, despite the fact that the dollar is rallying yesterday. So gold yesterday totally ignored the strength of the dollar, but choose to focus on a upcoming Fed dovishness that is still on the path of cutting rates, and there's a risk of US dollar debasement going forward in the longer term because of the policy that is undertaken by the US White House administration, and also the government shutdown that could potentially we call it a derail US dollar being as a reserve currency, international reserve currency going forward. So that actually causes the gold to continue to have a steep rally. Now during Asia session, it finally cleared above the 4,000 psychological level. So yesterday it added 0.6%, and today in Asia session it continues to extend its gains to 0.7%. So later I'll share with you what are the intraday levels to watch out for gold XAU/USD. over here. So that sum up the first segment of today's daily dose. Now let me move on to the second segment. So today we will do the full suite of the daily dose, which cover all the 12 instrument daily intraday technical chart. Technical chart, given the significant movement that has been taking shape in the FX market as we are speaking right now. So let me expand my screen over here. All right, so let me, okay, so the screen is good. Yeah, correct. Okay, so let me start with the FX market first. Over here. Okay, okay, the euro dollar. So the euro dollar, yesterday we were neutral, or previous day we were neutral on Monday. So it broke below the neutrality zone at the lower limit of the neutrality zone at 116.50 over here. So if you look at the daily chart of the euro dollar, yes, it's still holding up, it's still slightly above this so-called trading right exactly at this medium-term ascending trend line that I drew from the low of 13th of January this year. But however, the RSI is rather weaker. So RSI is a momentum indicator. So the daily RSI remains lackluster as it shaped a series of lower high and broken below the 50 level mark and still has some more room to go down before hitting the oversold zone. So that being said, that there could be a risk that this medium-term ascending trend line support may not hold this ongoing bearish momentum that is being seen in the euro dollar. So the medium-term ascending trend line support is at 116.10 over here, 116.10. So given that the daily RSI is rather weak, and there could be a high probability that this 116.10 may not hold this ongoing bearishness in the euro dollar and breaking down lower. So with that, I will be using any potential bounce to fade this bounce and flip to a bearish bias using 116.90 as my short-term pivotal resistance on the euro dollar. First level to watch on the bounce, potential bounce will be at 116.50 over here, given that the hourly RSI has hit the oversold level. But I will use this bounce to flip to a bearish bias in any case of them that take shape, because of the technical elements chart on the higher time frame, it's more skewed towards the bearish side rather than bullish side. So a breakdown below 116.90 short-term pivotal resistance, also confluence with the 50-day moving average as well, that was taken down yesterday. So after 116.10 has been taken down on the downside, the next intermediate support level to watch will be 115.80, 115.30 on the euro dollar, which confluence with the minor swing low of 27th of August this year, and as well as the minor swing low of 5th of August. Only a bullish breakout above 116.90 would reverse the honors back towards the bulls again to revisit 117.60 in the first step. So that's for the euro dollar. Next up will be the sterling pound. So the sterling pound, we were neutral. So right now it's on Monday, and right now it's testing the lower neutrality limit at 133.90. But given the fact that the euro dollar is being weak as well, that could potentially drag down the sterling dollar as well as the pound. So I'll be flipping to a bearish bias for today using 134.65 as my short-term pivotal resistance level. A breakdown below 133.90 will potentially see further weakness on the sterling pound or the sterling versus the dollar to retest the 26th of September minor swing low at 133.30. Failure to hold at 133.30 may see further weakness towards 132.65, which is the minus congestion area of 4th of August and 6th of August as it approached towards the lower limit of this minor descending channel that has starts to form since its ex-post FOMC meeting outcome or price action behavior on 18th of September, that this 18th of September at that point in time. Only a bullish breakout above 134.65 will invalidate the bearish bias on the sterling pound to see it rallying, retesting the 20-day moving average, and as well as the 1st of October minus swing high area and the 23rd of September minus swing high area, all aligning at 135.10, 135.35. Only a breakout above 135.35 will flip the bias back to the bulls for it to stage a minor recovery in first step to revisit the next intermediate resistance at 135.95 next. So that's for the sterling pound. Next up will be the Asia Pacific currency against the dollar. All right, over here, kick-starting with the Aussie dollar. So the Aussie dollar also broke down below 65.75 over here, and now it's also, that is our pivotal support that we have on Monday, and now it's fast approaching the 50-day moving average that is acting as the next support at 65.45. So given that it's fast approaching this 50-day moving average, if you were to be bearish, I mean, it's only close to about what 20 plus pips more to go. So I will flip to a neutrality stance for today on the Aussie dollar, neutral between 65.45 and the upper limit is at 65.85, where previously price action tested on the 2nd of October and yesterday as well during the start of the US session before it gave way. And in today's Asia session, it tries to actually recover, but can't have a proper recovery and did this minor intraday sell-off in line with the Kiwi dollar. So neutral between this psychological level at 65.85 and 65.45. So only a push up above 65.85 will potentially negate the bearish bias on the Aussie dollar, and in first step seeking out to test the upside trigger level at 66.20, where yesterday it tries to have an intraday break, but it didn't have an hourly close above it before that bearish negative feedback loop seep back into the Aussie dollar yesterday and into today's Asia session as well. So neutral between 65.85 and 65.45. Now back to the dollar yen over here. So on the dollar yen chart, before I flash out the dollar yen chart, there's this particular fundamental factor that I share with you on the dollar yen. It's now moving against this fundamental factor, which is the yield spread between the 10-year US Treasury and the 10-year JGB yield, and the 2-year Treasury minus of the 2-year JGB yield. So if you look at these three lines, they're actually moving in direct correlation on a longer term basis. This is a weekly chart. So the bottom of the chart is the dollar yen. So every time this top line here, the yield spread between the 10-year US Treasury yield minus the 10-year JGB yield, and the 2-year Treasury yield minus the 2-year JGB yield, every time these two lines move up, the dollar yen will move up as well. And if these two lines starts to come down, the movement of the dollar yen will be subdued and starts to trend downwards and instead go sideways since the start of July 2024. Because since July 2024, the yield spread of the US Treasury yield minus of the JGB yield has starts to decline over here. And in fact, right now, the 10-year US Treasury minus of the 10-year JGB yield spread has broken down on the intraday basis below the 2.47 major support level, and is now trading at 2.439%. And the shorter 10-year one, the 2-year, that's more sensitive to the respective central bank monetary policy, has already broken down earlier in August, mid of August this year, the 2.9% major support. So very clearly, the movement of the dollar yen now is totally ignoring this fundamental macro factor, which is the US Treasury yield premium continues to shrink versus the Japanese government bond yield over here. But nevertheless, market participants are right now very fascinated with the new Japanese PM and potentially looking her to be the next Abe, where she potentially could she could potentially push up a very aggressive Bank of Japan easing policy again, but that doesn't go in line with the fundamental that we are looking at right now. But we, in the very short term trading, fundamentals will take a backseat over here. So in the very short term trading perspective, we got to look more at the sentiment side of the story. So for the sentiment side of the story, going to the dollar yen chart over here. All right, so if I go to the daily chart of the dollar yen, so very clearly on the daily chart of the dollar yen, we start to see it breaking out above this previously bearish ascending wedge upper limit. Okay, very clearly it got triggered out yesterday at the 150 50 level, 150.50 level over here. So once the trigger breakout, it continues to rally very steeply into the US session and continues up its positiveness in the today's Asia session, with the next key medium-term resistance coming in at 154.50 over here. And 154.50 is the major descending trend line that has been in place since 3rd of July 2024 high. So this high was being formed after BOJ intervened under the instruction of the Ministry of Finance from Japan to cool down the yen weakness by selling dollar, buying back yen. And after that, they intervened again on 11th of July 2024 that formed this resistance level at 15835/80. All right, so in the very short term, potentially we may see further squeeze up towards 15450 area there about on the dollar yen. This is the daily chart of the dollar yen. So now going to the hourly chart of the dollar yen over here, now it's coming close to some intermediate resistance level based on a Fibo extension cluster level at 14280. And if you go to 14280 over here, that also constitutes some congestion area previously of 7th of February this year. So bear in mind that the hourly RSI has now back hit the overbought level. So there could be some form of a minor pullback taking shape. So minor pullback, first support level to watch will be 15182 over here, 15182, with the pivotal support coming in at 15115, which is the former minor swing high area of 28th of March 2025, got taken out yesterday, now turns into a critical pullback support area to watch. And if you do the Fibo retracement of this ongoing short push up from the low of 1st of October, that also constitute to the close to the 38.2%, 23.6% Fibo retracement to maintain this ongoing 1, 2, 3, 4, 5 wave up sequence, right, from an Elliott wave perspective. So using 15115 as my pivotal support level for the dollar yen, we will be bullish on the intraday basis in any potential pullback. So as long as this potential pullback didn't surpass below 15115 short-term pivotal support on the dollar yen, the next resistance level to watch en route will be at 15365/15390, followed by the key medium-term resistance level at 15450, which I shared with you earlier on the daily time frame chart of the dollar yen. Only a bearish breakdown below 15115 will jeopardize the bullish tone of the dollar yen to see it slipping back down to revisit the former ascending wedge resistance, now turns into a pullback support at 150.50. If this 150.50 level can't hold, potentially it may see a deep extension towards Monday US session low at 14980. So that's for the dollar yen. All right, now let's proceed to the major stock indices over here, starting with the Hong Kong 33, representing the Hang Seng Index. So the Hong Kong 33 just reopened from its public holiday on Monday due to the break of the mid-autumn public holiday in Hong Kong. So price action gap down over after the day-long break on Monday and day-long break on Tuesday, pardon me, not on Monday. So, but this gap down managed to survive at our 26570 pivotal support level previously that we mentioned. All right. So, given that it still managed to bounce from this support level, we will still maintain that bullish bias. But this bullish bias odds will increase if price action able to surpass today's Asia session high over here at 26,935 level. All right, let me put it in my panel. 26,935. Okay, so this will be my upside trigger level, 26,935. Above this level, potentially seek out last Friday minus swing high at 27,205. Okay, let me repeat. Pivotal support remains the same, 26,570. Still maintain that bullish bias because this support level managed to bounce. But however, this bullish bias odds will increase if we have the clearance above the upside trigger level for today at 26,935. Above it, potentially seek out last Friday minus swing high area at 27,205. Only a bearish breakdown below 26,570 will invalidate today's bullish reversal scenario on the Hong Kong 33, representing the Hang Seng Index, to expose the next near-term support level at 26,280, followed by the critical minor swing low of 23rd of September and 26th of September at 26,060. So that's for the Hong Kong 33. Next up will be the Japan 225, represent Nikkei 225. So the Japan 225 managed to squeeze up, almost hitting our our resistance level that we highlighted on Monday, where we have a bullish bias. So given the fact that this resistance level has been made, right now there could be a risk of a minor pullback taking shape or a mean reversion rebound, a mean reversion decline taking shape on the Japan 225 towards the gap up support area that has been taking shape on that was seen on Monday. So we will flip to a intraday bearish bias on the Japan 225 for this potential minor mean reversion decline scenario to gain traction using 48,860 / 49,070 as my short-term pivotal resistance level. Two support level to watch out for this mean reversion decline scenario to play out on the intraday basis will be 47,050, which is the former ascending channel resistance broken out on Monday that previously that I drew from 1st of August now turned into a pullback support at 47,070. Unable to hold at 47,050 may see the mean reversion decline scenario extending further towards the downside, towards the gap support that has been formed on Monday at 46,170. Only a bullish breakout above 49,070 will invalidate today's minor mean reversion decline scenario to see the continuation of the impulsive up move sequence of the Japan 225 heading up towards 50,087, 50,540, which is a Fibo extension cluster level. Next, so that's for the Japan 225 over here. Next up will be the Germany 30. So the Germany 30 represent the German DAX continues to remain unscattered given the ongoing political fiasco or the political we call it upheaval in France right now. So it's not having a negative feedback loop into the Germany stock market due to the sudden resignation of the new French Prime Minister. So the Germany 30 managed to continue to be held right above our intermediate support that we have on Monday, but still continues to trade in a sideways range fashion between 24,280 and the first resistance that we have at 24,547, 24,655. So unless we have a clearance above 24,655, if hourly close above it, then I could tighten my pivotal support level to 24,280. So for now, still using 24,155, 24,090 as my pivotal support level for the Germany 30 as it starts to oscillate within this medium minor ascending channel that has been formed since the low of 25th of September. So maintain that bullish bias, but the bullish bias got to gain traction with an hourly close above 24,655 for sure, given that this level here has been a intermediate resistance that caused it to go sideways since last Friday. So above 24,655 take us up higher towards the upper limit of this minor ascending channel, with the next resistance coming in at 24,780, the 2.618 Fibo extension taken from the low of 17th of September, and as well as this will be the fresh all-time high above the current all-time high at 24,655, which is still in play since 10th of July 2025. All right, only a bearish breakdown below 24,090 that will invalidate the bullish bias stance on the Germany 30, representing the German DAX, to see another choppy minor corrective decline sequence unfolding again towards the 50-day and the 20-day moving average, acting as the next intermediate support area between 23,900 and 23,760 over here. So that's for the Germany 30. Onwards, next will be the major US stock indices, starting with the Dow Jones Industrial Average, which is the US Wall Street 30. So yesterday I highlight that, do recall that in order for the bulls to gain traction, despite that the initial sell-off on Monday managed to survive at the 20-day moving average, very close to the 20-day moving average, which right exactly at the 46,400 short-term pivotal support that we predefined, but bulls got to break out above 46,920. So indeed, yesterday price action before the start of the US session hit 46,920, printed a high of 46,924 before losing momentum again. But once it came down very close towards the 46,400 pivotal support, deep buyers coming again. All right, so these are very two key technical levels that has indeed formed on the US Wall Street 30. So given that it's still holding above the 20-day moving average and holding above the 46,400 short-term pivotal support level, hourly RSI continues to shape a higher low over here. There is no point to be outright bearish right now, given that the technical factors on the short-term basis at this juncture does not support a bearish scenario. So we will still maintain that bullish bias with the same level on the US Wall Street 30, 46,400 short-term pivotal support level. Upside trigger level remains the same, which is the level that I highlighted yesterday, where indeed it has that minor bearish reaction, 46,920. 46,920 surpass with an hourly close above it, then that would increase the chance of another impulsive up move sequence unfolding on the US Wall Street 30 to take it up higher towards 47,160, even 47,340 slash 47,410 in the days ahead, which is being defined by a Fibo extension cluster level over here. And as well as if we do a channeling projection from taken that we now have see 3 higher low, that also constitute towards the upper limit of this minor ascending channel that is forming since the low of 26th of September. Only a bearish breakdown below 46,400 that will invalidate the bullish reversal, bullish bias scenario on the US Wall Street 30 to kickstart another minor corrective decline sequence unfolding, exposing the next near-term support at 46,040 level. Next up will be the SPX 500. So the SPX 500 managed to survive at the first intermediate support level that we highlighted, 6,714 over here. Okay, let me clear this. All right. So right now, no change. Price action still remains above our former adjusted pivotal support that we have, that we highlighted on Monday. So this level will remain the same for the SPX 500. This is the hourly chart. 6,690 will still be my pivotal support in any dips to maintain that bullish bias on the SPX 500 over here, given that the RSI now also managed to bounce off close to the oversold level yesterday. First resistance level to watch will be the current all-time high that's being seen on yesterday as well, which is 6,764. 6,764 above 6,764 take us up higher towards the next Fibo extension level at 6,800, which is also a psychological level as well. Only a bearish breakdown below 6,690 will negate the bullish tone to see a much more deeper minor corrective decline sequence unfolding, revisiting the rising 20-day moving average, which is acting as the next intermediate support at 6,650, which is the minor swing low area of 1st of October, formerly got taken out and retested it on the 1st of October. So previously was a minor swing high of 26th of September, broken, retested and bounced. All right, so this will be the next important support level to watch at 6,650. If 6,690 can't be survived today by the boost. All right, so that's for the SPX 500. Next up will be the NASDAQ 100. So the NASDAQ 100 also managed to bounce off from the first support level at 24,795, which is also the lower limit of this ongoing minor ascending channel that I drew from the low of 2nd of September over here. So no change. Pivotal support remains the same at the 24,710, 24,620, which we have highlighted on Monday. Also constitute with the rising 20-day moving average as well, coming very closely. So price action yesterday tried to test our first resistance, come break 25,090 before shipping that pullback. All right, on the intraday basis, on the backdrop of that negative news flow from Oracle. So given the fact that I managed to bounce off from the minor ascending channel lower limit, we'll still be using 24,710, 24,620 as my short-term pivotal support zone to maintain this bullish bias on the NASDAQ 100, unless we have a hourly close above 25,090, then I could tighten my pivotal support level today to 24,795. All right, above 25,090 take us up higher towards the next Fibo extension cluster level at 25,370, 25,370, as it's going to oscillate within this minor ascending channel from the 1st of September 2025 low. Only a bearish breakdown below 24,620 will invalidate today's bullish biasness on the NASDAQ 100 to see a deeper minor corrective decline sequence unfolding, revisiting the next intermediate support level at 24,380, which is the minor swing low area of 26th of September. Next. All right, so that sum up all the intraday technical outlook on the major stock indices. Let us now proceed to the commodities market over here, starting with the Gold XAU/USD. So Gold XAU/USD hit our resistance level, two resistance level, 40,011, 40,024 coming next, 3,980, 3,985 over here. All right, so now what we're going to do now is the RSI is coming to the overbought level. So we will still maintain that bullish bias in any form of any dips going forward over here, with the first support level to watch will be this US session low that's being formed yesterday at 3,966. So I will tighten my pivotal support level to 3,932, which is if you do that Fibo retracement of this ongoing 5-wave up, 1, 2, 3, 4, 5 towards the current intraday high, that constitute the 23.6% Fibo retracement. Okay, very close to it, and also very close to yesterday's Asia session low as well at 3,932. So using 3,932 as my Titan short-term pivotal support level, first support level to watch for a potential dip will be at 3,966. So still maintain that bullish bias in any potential minor dip using Titan support at 3,932. Above 4,024, the next resistance level to watch out for will be 4,084, 4,087, which is a Fibo extension cluster level. Only a bearish breakdown below 3,932 that would invalidate the bullish acceleration scenario on Gold XAU/USD for today to flip it to a minor corrective decline scenario unfolding, exposing the next near-term support level at 3,892, 3,864 again, which is the lower limit of this ongoing minor ascending channel from the low of 22nd of August low. So once it hit below this level, 3,864, I'll be on the lookout for bullish elements to flip my honors back towards the bull again for Gold XAU/USD, given that its medium-term uptrend phase still remains intact for gold. All right, now lastly will be the West Texas crude oil over here. So the West Texas crude oil over here managed to bounce yesterday after covering the gap up that is being formed in Monday Asia session. So right now it's fast approaching the 20-day moving average, which is so our short-term pivotal resistance zone at 6260/6330. So we'll still maintain that bearish bias over here for below 6260/6330, short-term pivotal resistance zone for the West Texas oil. Support level to watch out for on an intraday basis over here. So let me share with you guys. Will be taken into account of yesterday's low. All right, at $60.90. Okay, 60.90 over here. A breakdown below 60.90 potentially seek out the 15/13 May 2025 low at 60.55/60.10 over here. So that will be for this West Texas crude oil. Only a bullish breakout above 63.30 will invalidate this bearish bias scenario for it to revisit yesterday's low at 60.90 and see a further squeeze up towards the 50-day moving average, which is very close to the next intermediate resistance zone at 64.55/64.90. All right, so that sum up the intraday technical outlook on today's broad-based cross asset classes, 12 of them in all. So before we go, let's take a quick look at the economic calendar. What are the key data to look out for today's session? So heading into the European session over here, we do have one ECB official speaking, ECB Bosch at 5:15 p.m. Singapore time. And we also have Germany industrial production earlier at 2 p.m. Singapore time. That could these two events that could influence the movement of the euro crosses, and as well as the Germany 30 CFD index. And very interestingly, for the industrial production, market participant is expecting a weak print, month-on-month print of negative growth at -1% from a previous positive month-on-month growth at 1.3% in the previous month of July. Then thereafter, as we head into the US session, we have two US officials speaking, Fed Musallam and Fed Bar. at 9:20 and 9:30 p.m. Singapore time. And thereafter at 10:30 p.m. we have the weekly EIA crude oil stockpile change that could potentially influence the movement of the West Texas crude oil. That will be at 10:30 p.m. Singapore time. All right. Then thereafter, we have the release of the FOMC minutes over here. So that will be pretty much crucial for the markets to decipher that ongoing debate between the US Federal Reserve officials, where the doves managed to gain a foothold in the previous September meeting and allows the Fed to cut to ignite its first interest rate cut in 2025. So that is at 2 a.m. Singapore time tomorrow morning, Thursday, 9th of October, and followed by 3:15 a.m. and 4:45 a.m. two Federal Reserve officials speaking, Fed Kaga Street and Fed official bar over here. All right, so that will sum up today's daily dose of market insights. A bit a longer session today because of the current volatile movement in the global markets that we've seen yesterday, that I hope that I'm able to explain to you and share with you much insights for today's daily dose. So I'm Kelvin here signing off. I wish you all a great day ahead and we shall speak again tomorrow. Thank you.